Hello, guys. Um, Today, I kind of want to talk about a few different concepts here that I've really tried to add into my trading, and really, I really believe that these things you should try to add into your trading into a systematic manner, right? That means like you want to have a system in which you can add these things so that they become part of your trading, because sometimes as traders we learn things, and learning things technically doesn't necessarily mean that you're gonna apply them into your trading, right? It just means that you know something in theory, but in my perspective, knowing something um, is applying a thing is actually part of knowing the thing. If you know something but you never apply it, I mean, you're as good as somebody that doesn't know anything, right? So I've noticed that a good way for me to apply things that I know is to try to create systems that would force me to do things with whatever I've learned in mind, right? So that's kind of a nugget and something that I've been trying to implement into my trading. So just having, whenever I learn something that I think is really interesting or that I think can make a big difference into my trading, I immediately go to my system and trying to find ways to kind of implement those things into my system so that it's kind of a synchronized way of trading for me. But so that's what I've been trying to do. So today I really want to talk about a few things. So number one, I want to talk about moving averages. I want to talk about Fibonacci, retracements and extensions. I want to talk about support and resistance, and I want to talk about whole numbers. Right. So first, I'll start with moving averages. All traders, if you just started trading, you probably tried some type of moving average crossover strategy. That's probably one of the most used strategy by new traders, and I think it's a good place to start actually. But so what are moving averages? So the way I kind of look at moving averages is a way to gauge the fair value of an instrument, right? So if you're trading stocks, moving average would tell you the fair value of your instruments. Obviously, there's different type of moving averages, right? And the bigger the period of your moving average, the longer the value that you're looking at, right? So if I'm looking at a 200, obviously that's longer period, 200 data points, and if I'm looking at a 9, it's fewer data points. Typically, I only use 3 moving averages. I use the 9 for tighter moves, like especially if you're looking at power trends and things like that. 9 moving averages are very helpful. I'm looking at the 20 for midterm, and then I'm looking at the 200 for overall direction. So really, like I said, the moving average is really just a way for you to gauge a few things, right? Number one, it tells you the direction of the trend without you having to think. So sometimes there's a situation where, especially if you're a day trader or scalper or whatever, and you're looking at a chart, right? It's good for you to have cues that tell you that a trade is a good trade or not. Now, I'm not saying that technical analysis and looking at lower lows and higher highs and things of that nature is not important. But I'm saying in some instances, it's always good to have visual guides that help you make decision faster, because in my opinion, it's more efficient, right? So um, so moving average can tell you the direction of the trend and can tell you what's the likely direction of your stock. Obviously, if your stock is above the moving average, the likelihood of the upside is higher if it's in general. And if your stock is below the moving average, the likelihood of a downside is higher in general, right? Now, there's specific cases that you have to look at other things to be able to gauge what's going on. So first, direction. That's what moving average tells you. Second, moving average actually tells you how far from its value your instrument is, right? If you're trading something that's going far away from its moving averages, let's say the 20 and the 9, then the probability of retracement of your instrument is higher, because the price, by going away from its moving average, is actually going away from its average value, right? So that's also very helpful, because whenever you have let's say you have a trend and the trend starts to get away from its moving average, you need to start thinking about, what's going on. Is that a climatic move going on? What, those type of things. So again, this is a cue for you to start to think about things, right? That doesn't mean that it's the end all be all or none of that, but it's something that gives you a clue just by looking at the chart, right? Obviously, the price also will do that, but again, I'm thinking about just getting used to looking at the chart with certain things, right? Personally, for me, it works. The other thing that the moving average will tell you, like I said, value on the upside, right? It's too far from its value, but the same thing on the other side, right? When the price retraces to the moving average, tells you that the price is closer to its actual average value, right? So if you have a stock that's moving higher, kind of like this, right, getting away from its moving averages, the stock is going to retrace back to the moving average to a fair value. And if you have something that's coming back to its fair value, what are people going to do? They're going to take action, because the instrument is closer to its value. Okay, now I can buy it so that I can sell it when it's higher than its value, right? And same thing goes on the opposite side. If something was coming down, got away from its moving averages, right, and then came back, now I can start selling it because it came back closer to its actual value, right? So that's the general understanding. So it gives you a gauge of how far an instrument is far from its value. And the other thing too is that moving averages actually serve as support as area of support for instrument that you're trading, just because other traders use them. So whenever a price is hitting a major moving average, typically you would have some type of reaction, right? So you want to be aware of that, right? Because we're not trading instruments, right? We're trading people. And this is another thing that I've been really trying to implement into my trading, is just the kind of the human aspects of it, right? Because I take certain action when I see certain things. I'm trying to think about, okay, what other traders would do. Like, I'm trying to think about, okay, why this is happening, right? So that's why you want to have moving averages, for those three reasons that I named. And then once you understand these things, you can build your system around that moving average, because it can really help you stay out of bad trades, right? Especially if you start looking at your data and figuring out what's going on. So personally, for example, I've noticed that I do very bad buying stuff that's below the moving averages, right? Typically, I use the 20 and the 200 as a gauge for the proper direction to take trades. If an instrument is below the 20 and the 200, the probability of me buying that stock or that instrument is very, very low. So I'm trying to stay away from counter trend situation, especially unless other things happen. Like I said, there's always exception, but in general, if you're starting trading, you want to use these things as gauge to avoid bad things. Sometimes really trading is as much avoiding bad decision as making good decisions, because sometimes you don't really know, especially as you get started as a trader, you don't really know what works, right? But as you trade and as you review your trade and backtest your strategy, you get a good gauge of what doesn't work, right? And I found personally that counter trading, it doesn't really work for me, right? So I'm trying not to do that. Okay, next, let's talk about Fibonacci's, right? So Fibonacci's, really, you have Fibonacci retracements and then you have Fibonacci extensions, right? Those are really the same things, because it's still Fibonacci levels. But the Fibonacci retracement basically tells you if a price has moved from a bottom to a top, or from a top to a bottom, it gives you the percentages of pullback that the stock can have, right? And those levels are important because those levels are used by traders to make decisions, right? So that's why you should know them, right? Like I said, we're trading people, so if people use them, then it'll be helpful for you to know what those are and use them as well, because then you can make decisions based on what other people might do, right? So moving averages, to have that, you just go here on trading view on the side, you click on moving average, and then to draw to draw a Fibonacci retracement, sorry, you find pivots, right? So that's just areas where the instrument turned, right? The price changed direction. So for example, clearly here the price was going up and then turned and now it's going down, right? So you would draw a Fibonacci, your first Fibonacci point here, you would drag it down to the lowest point here, and then you have the Fibonacci levels. Simple, right? And you can also do the same thing to the downside, to the upside. So you find a bottom, you find a bottom, say this is your bottom. Clearly you can see that this is your top. There was a turn here. You come here and then draw your Fibonacci like that, right? And if you want to learn more about Fibonacci's and you know where they come from and stuff like that, that's fine too, you know. But I'm talking about strictly for the purpose of trading. To me, these are just levels that I'm looking at because I know that it's highly probable that people are going to take action at these levels, right? So that's why I draw them. So yeah, so this is Fibonacci's. I try to keep things simple, not overthinking. And as you draw them and as you get more familiar with, you know, should I use the bodies, should I use the tail, you get a gauge of what to use and when to use what to try to fit what's on the chart, right? So for example, if you're drawing a Fibonacci level, Fibonacci retracement, and you're noticing that Fibonacci retracement is not supported by the price in other areas, you probably not drawing it right. So typically if you're drawing a Fibonacci level, whenever you draw them, the price should respect those Fibonacci levels in many different areas. Like for example, if I'm drawing this Fibonacci here, that's a good one. So are you going to use that top or are you going to use this top here, right? So well, you got to look at the price, right? If I'm looking at this price here and I'm drawing this, I can see that, okay. So if I draw it here, I can see that this price respected here, this bottom candle respected it here, this kind of respected it here. And again, another thing too to think about is that those things are areas, right? This is not an exact science, right? This is you're trying to get a gauge of things, right? Obviously you got to use market structure, supply, demand, and all other things to decide what trade you're going to take. But this is mainly just to give you an edge on where the price is likely to turn, right? And typically I try not to just do it on any chart, right? I want to do it on a chart that's special, a chart that has, you know, that has a gap typically, right? Whenever you have a gap, that's where you have supply, demand, and balances, and that's where you can start using your fibs in combination with your moving averages and other things to kind of get, you know, an edge there. But anyway, I digress. Now, Fibonacci extensions. So Fibonacci extensions kind of give you those same levels that you were getting from a retracement, but kind of tells you, okay, if the price has moved from a low to a high and then retrace a certain amount, these are the levels that you would see when the price bounces back from that retracement place, right? So let's say I'm looking at this move up from here to here, right? So I'm drawing the move up again. Since that's a move up, I'm going from low to high, right? And then I'm drawing the retracement back down, right? So this is the retracement level that you would see as the price starts to go up, right? And another thing also that I mentioned, sometimes in some instances Fibonacci levels, actually you have to adjust them as the price move, right? Because for example here you could see that the price made a new low, right? So if I'm drawing the fib now, I would actually use this low instead of that old low because the price made a new low, right? And you could see here that low probably is going to be respected on the move up, but I'm saying that you can't just keep them on the chart and not adjust them. So typically you would have to adjust those levels as the price makes new lows and new highs and all these type of things. So what can those be used for, right? Typically Fibonacci levels you want to use to be able to assess areas where the price might turn, or you can expect sellers or buyers, right? Just giving you an idea of, okay, these are the areas where I should start thinking about making decisions, right? Um, so now support and resistance, right? Support and resistance just tells you at what areas buyers or sellers took action, and that they're more likely to take that same action if the price comes back to the area, right? So typically a support is a place where buyers took action, right? So here would be a support. For example, you could see that the price turned when it came there, so some buyers took action. You can expect buyers to do the same thing, right? Here, that would be a resistance, right? You can expect sellers took action here. You can expect sellers to take action here again, right? So, and again, these are areas, right? These are areas. These are not whole numbers or actual values. These are areas. It's kind of like if you have a car that's driving, right? And that car is going at 70 miles per hour. If you press the brake, well, that car is not going to stop dead on where you press the brake. That's the same thing with price and momentum, right? You see these huge candles, the price was moving higher, right? Even if sellers are introduced into the market, the sellers cannot just absorb all the buying that's going on. So it's going to happen progressively over time, right? And then you start to see, tails, and the price will start to the momentum on the side that the market was going on will start to die down, and things of that nature. So that's also why you have these overshoots, right? So keep in mind levels, support, resistance, Fibonacci. It doesn't matter what you're using to determine where the market might pivot. These are all areas. Nothing is round numbers. Nothing is precise, right? Now I'm gonna get into whole numbers too. So basically, for whatever reason, human beings like whole numbers whenever they do stuff, right? So for example, here you can see 200 exactly. So the high of this candle is 199.6, right? So presumably there was some hoarders laying around that 200 area, so people sold at that area. So whenever you're looking at support and resistance areas and things like that, you want to make sure that you look at the whole numbers too, because those are areas where orders will be laid. And typically if you're trading breakouts or things like that, those are areas where you would see a battle between buyers and sellers, or some type of accumulation or distribution, and you would see the price consolidate below those whole numbers a lot of times. So so that's why it's important to keep in mind that whenever you're looking at all these things and you're looking at actually taking trades, make sure that you're using, for example, for a breakout, you want to make sure that you're using the breakout above the whole number, for breakdown below the whole number. So the whole number is just another thing that you have to look at, just to make sure that you're not taking action before the whole number, because sometimes you could anticipate the break. But obviously the chart will tell you what number you should use, but if the whole number is there, obviously you want to take a look at it. So okay, so how does all that fit into a system, right? So especially if you're trading based on the trend, right? You want to look at moving average, get your trend. If you want to make sure that you're not trading something that's extended, you want to look at how far it is from the moving average. If the price is coming back towards the moving average, you want to make sure that you're looking at it, because it's probably going to be support or resistance to the instrument that you're trading. You want to use Fibonacci levels to have an idea of where the price might turn, or when the price might bounce. And then you want to use support and resistance for the same purpose, right? To kind of have an idea of where sellers might be or where buyers might be. And lastly, you want to try to find areas of confluences between all of those things, right? So for example, if I'm trading and I'm seeing a support, right? Well, okay, this is my support. I think it's a support. That's just me, right? Like, I don't know if that's what other people are looking at and thinking that that's support, right? So if I'm drawing a support, I want to try to make sure that support is also a Fibonacci level, because then that adds an area of value to what I'm looking at. Like, that it's a confluence thing, right? So if two things are true, right? It's a level, it's a support, it's also a Fibonacci level. Oh, wait a minute, it's also a Fibonacci extension. It's kind of the same thing, but the moving average is also sitting in that area. Now I'm looking at something that has a lot of things going in my favor, right? Because the likelihood now of whatever that I'm trying to do is actually making sense, right? Like it's very likely that this is actually a support level if all of those things match this specific area, right? Um, so for example, something that I saw today, I think there was, let's say PLTR was it? Sometimes I just look at chart. So this is the type of chart that I'll actually be looking at, right? So if you look at something like PLTR, for example, right? And another thing that I try to do is that if I am looking to trade something, I would make sure that I draw these things on a time frame that's bigger than the time frame that I'm trying to trade, right? Because it's typically not helpful to draw those things on a lower time frame, even though you can. It's also good, so that's another thing too. You can have Fibonacci levels of different time frame match as well to be able to have confluence, right? Because that's all it is about. So for example, that's a really good example of confluence here, right? So for example, you have this area here where sellers took action, so that's obviously a resistance, right? You have this area here where sellers took action, and then another concept is resistance once broken becomes support. So this area you had some sellers that took action, price went down. So if this area get broken, that's going to become support, right? Okay, there you go. Now I have my support and my resistance, right? Now I want to draw my Fibonacci's. Let's say I'm on a daily right now. So the most recent move is this down move right here, right? That's the down move from here to the lowest low, right? So if I draw my Fibonacci level here, not extension, if I draw my Fibonacci here, let's say I draw it here. All right, so this is my Fibonacci. Okay, so you can see that this area here, make sure I get it right. Okay, so you can see that this area here is somewhat respected, right? So this is an area that I think there's going to be an action. Something is going to happen in this area most likely, right? So this is an area that I would look at, right? Here, this area between support, resistance, and the Fib. So this is the Fibonacci retracement. Now you can also do the extension, right? So you had, for instance, if you look here, and as you get better at using them, you get a better gauge of it. So let's say you have the price went up from here and retraced here, right? You can see that here. So let's say I want to try, and again, these type of things you would have to, typically I do a few of those to try to see, okay, what's matching, what's not matching. This is not an exact science. This is just, like I say, you're trying to find confluence between different things. So here the price went high here, and then I'm retracing this here. Right? As you can see, you see that? You see that? So I'm drawing this to this low, and I can see that same area is a confluence between this Fibonacci extension, the other retracement, and the support area that I just drew, right? So that leads me to believe that this area is actually meaningful, that this area means something, so I can use that as a support, right? And sometimes whenever, let's say I'm looking at this chart is on a downtrend. Sometimes I go on a bigger time frame to see, because it's gapping up, right? I want to see where the uptrend would be. So let's say I would go, for example, on weekly, right, to be able to catch that up move. So if I look on weekly, I have an up move, a retracement to the downside, and then a gap move, right? So then I'll come here, same thing. You're looking at this low here, going to that high here, and going to this low here, right? There you go. And then maybe you can try and say, okay, what if it was here? So you can see that this matches my area, right, better than this, right? So then I'll use this as a retracement level, right? So you can see that this is an area of confluence between the resistance that I drew Fibonacci levels, and then I would go on a daily, right? I would go on a daily and look at it and be like, okay, the price respected it here. It was respected here. You see, it was kind of respected here. It's kind of respected here too. This is that same level that I was drawing earlier. So you could see that like the price is respecting this area in other places, right? And that's kind of how you draw these Fibonacci's, because it can't just be it can't just be I drew those Fibonacci's and then that's it, right? You want to find areas of confluences between things that you're drawing, because it's just looking at a chart. There's nobody there to tell you what's going on. So the more things you can make match and the more things agree with each other, the higher likelihood of whatever you're drawing is actually accurate, right? Especially that those things are areas. So you want to have multiple things that's kind of telling you that, hey, this is what you should be looking at, right? So yeah, this is kind of it's what I try to implement into my systems. And then obviously you have your moving average. This is something that you would want to buy. See, it's above the moving average, but also, right, depending on it, typically, again, there's a lot more to this than just buying above a moving average or things like that. But depending on what you're doing, you can also start to looking at moving average, especially in your entry time frame, to gauge things, right? Like for example, if I go on a 1 minute for that same instrument, right, if I was looking at it, I can start to take a look at these fib levels, right? Like I can start to take a look at these fib levels and what action I should be able to take. Like you could see, like here, like we talked about overshoots, right? This is an overshoot, right? Moving average, the 200 here. Do you see how reaction to the 20? So these are things that you could do. Like it's above the moving average. You could look to buy here. So again, these are things that you look at to be able to make some type of decisions, right? But then you have to add other layers to that and add that to your system, do the back testing and all that kind of stuff to be able to make sure that works for you. But this is the type of things that I'm trying to implement into my trading and my systems to make sure that I'm successful. And also, this, like I said, this is kind of a search of implementing and trying to finding what works, right? Because ultimately, that's what we're doing, right? You wanna try to have a system come up with something that works for you, and then back test it over time and figure out what works for you or what doesn't work. So I just wanted to share some of the things that I've been looking at and that I've been implementing into my trading to try to improve, and I thought that might be helpful. So use them, use moving averages. Don't worry about people talking about you need to trade with a clean chart. I mean, the goal is not to trade with a clean chart. The goal is to make money. So use moving average, use Fibonacci retracement and extensions. Pay attention to the whole number. Use support and resistance, obviously, and you should be okay. Thank you for watching the video. Like and subscribe, and see you at the next video.